Hey everyone, welcome to another episode of the Market Disruptors Show. Today I am sitting down with Brent Johnson. He is the CEO of Santiago Capital. It's a wealth management firm in San Francisco. He's also been talking a lot about the Dollar Milkshake Theory. I know a lot of people have been asking me about that, and I got questions too. So Brent, thank you so much for sitting down and talking to us today.
Yeah, absolutely. Thank you for having me. I'm looking forward to talking to you.
Great. So I gave a quick background, of course, but maybe you can just kind of give us a little bit of a bigger picture, kind of what you've been doing recently and what you're doing.
Yeah. So long story short, I've got Santiago Capital is a SEC registered investment advisor based in San Francisco. I do customized wealth management for a couple dozen clients. And then in addition to that, we run a private fund that is kind of focused on the Dollar Milkshake Theory, for lack of a better word. I've been doing this for a little over 20 years. I was with Credit Suisse for a number of years, went independent about 10 years ago, and, worked with a buddy of mine at his firm and then transitioned everything under Santiago Capital. So, I've been doing kind of overall wealth management and been involved in the market since kind of the mid to late 90s, I guess.
Yeah, great. And yeah, you have such a good, I guess, you're one of the big macroeconomic people. And I just love how you kind of take that big picture approach. And so, of course, a lot of that incorporates a bunch of different assets, but really it looks deeper into what the dollar's doing, the economy's doing, the politics are doing, and so forth. Is that about accurate? Is that kind of your viewpoint?
Yeah, exactly. I've always kind of been a big picture guy. When we get really, really down into the weeds, my eyes start to glaze over a little bit, and I kind of lean on other people for that. The tricky part is that the devil is in the details, so you can't ignore the details, but I've just always kind of naturally gravitated towards the big picture. And so that's the part that I really enjoy. And, I think it's probably more important. I think the big picture is probably more important now than, in the last 20 or 30 years.
Yeah, I agree. And I'm really fascinated by the macro picture as well. I love going back to history because it's almost like you see these changes that happen and then you can see how they affected the future, almost like a movie if I went back in time and, don't touch anything because it changes the future. Right. So do you think when you look at the big macroeconomic picture, maybe like the big moves are easier to predict than the short moves?
I think so. And I think if you can kind of just get in front of the big move and don't make any big mistakes, then you can kind of ride that wave and you don't have to get all the details correct. Right. And I also believe you can have the details 100% correct, but if you get the big move or the big wave wrong, it doesn't matter how much you know about the details. So I do think that the big picture is extremely important. And I think it's probably more important right now because if you're in the middle of a 20-year wave, you don't really have to focus on the big wave, right? You can just focus on the details and ride the big wave. But if you think that the big wave is going to turn or crash, or we're at kind of an inflection point of the big wave becomes really important. And I think maybe we're not at the apex of that big wave, but we're fast approaching it. So I think it's a very important time to understand the big picture.
Yeah, well, I'm in Southern California and I'm a surfer, so I think about catching waves all the time. So I love that analogy. But also I think like the way that you approach the market from a macro picture, it kind of gives you more of like a top-down approach, right? So like, hey, this is where the money is moving. Let's focus there, and then you kind of zoom in, as opposed to saying, hey, Brent, what do you think about this stock?
Right.
Is that about right?
That's absolutely right. I'll tell you, there's a few stocks that I kind of follow individually, but I'm not a stock picker. I have friends and colleagues and, experts that I can reach out to on the individual names. So I'm not going to sit here and say I'm a great stock picker like Warren Buffett or, somebody else, David Einhorn or somebody like that who really gets into the weeds on an individual position. What I try to do is, again, I try to find the big wave and try to figure out what sector or what market segment, and then from there, if I feel like I can get that right, then I can through the help of some friends and colleagues and partners, go down into the individual positions.
Right. Okay. Well, that's a really good background. It kind of sets up everything that we're talking about. So, I know you have this thesis, the Dollar Milkshake Theory, and you talk about it a lot, so you're probably getting sick of it. But it's such a great illustration to look at. And there's been a lot of moves in the U.S. dollar. There's a big wave of the U.S. dollar, but maybe even more turbulence, which makes me have even more questions about it. But maybe just kind of set the stage, give us the background on what the Dollar Milkshake Theory is, and then we'll dig into that a little bit.
Sure. So the first time I used the term dollar milkshake theory in an interview or presentation was a little over 2 years ago. It was late spring of 2018. And at the time, the US was embarking upon raising interest rates while the rest of the world was still stuck at zero or lowering interest rates. And so I was making the point that as we have higher interest rates than the rest of the world, that acts as a straw, and the straw goes down into this currency milkshake that all the central banks around the world had been mixing, since the great financial crisis. Euros, yen, pounds, dollars, pesos had all been injected into the global market, and it's just created this liquidity. And it was all looking for a home. And in today's day and world, just because money gets injected in Germany doesn't mean it needs to stay there. German investors can invest in the US or South America or Asia or wherever it is. And so my point was, it's not so important who injects the liquidity, it's who captures the liquidity. At the time, we were raising rates. The rest of the world was either lowering rates or keeping rates low. And I said that will act as a straw, which will help draw that capital into the United States. And that did happen for about another year and a half. But the point that I like to make is that while that has reversed, and as soon as they started cutting rates, I came right out and said, you know what, it's over. I thought we were going to get a couple more rate hikes than they did, but we still got 9 rate hikes in 2 years. And many people thought we wouldn't even get 1 or 2, and I said that we would get several, and we did. We got 9 rate hikes. I thought we'd get 10 or 11 or 12 maybe. We didn't. We got 9, and they reversed. But the point I like to make to people is that while the higher interest rates was the most dominant part of the straw that would suck up that capital, it has never been the only part of the straw. Okay. And what I mean by that is, if we take gold, and because I'm sure we'll probably talk about gold or Bitcoin or something at some point, yep. But if we just focus on fiat currencies for a minute, and let's say you've already got your gold allocation, you've already got your Bitcoin allocation, whatever percent of your portfolio it is. Now we can't talk about those anymore. Now we're just going to focus on 10 fiat currencies. One of those fiat currencies, even if they are all horrible currencies, one of them is going to do better than the rest of the other 9. And the fiat game is rigged in favor of the dollar. The whole system is set up to be advantageous to the United States. And the reason it's set up that way is because we set it up and we were the global hegemon. So the idea that it's a fair game, it's just not true. It is rigged, and it's rigged in our favor. And so the point that I wanted to make, for a number of these other reasons, in addition to interest rates, and even though interest rates have come down a lot in the United States, they're still higher than the rest of the world, yep. Or the majority of the rest of the world. And so there's all of these factors that I believe over the next 2 or 3 years will lead to global capital flowing into the US dollar, and by transition or whatever, once it gets into the US dollar, it'll find its way into US dollar assets, whether that's treasury bonds or real estate or cash or equities. I think that US assets will outperform foreign assets over the next 2 or 3 years as this big kind of fiat currency game kind of comes to an end. And and as a result of that, I think that the fiat currency game is kind of coming towards an end, or there will have to be some kind of a reset of some kind. But the point I'd like to make to people is that the US dollar will die from its strength, not its weakness. Or it is its strength which will cause the system to be reset, not its weakness. That's my belief anyway. We'll see if I turn out to be right, but that's my belief.
Yeah. So would you say that it's the weakness because of the trade imbalances then? Because if the dollar is too strong, it makes the US less competitive?
That's part of it. Well, that's part of it, but it's also, it wrecks the rest of the world. It wrecks the entire monetary system. And what I mean by that is, this gets a little bit complicated. Now, I try to keep everything simple, but it is a very complicated topic. But in our world, money is loaned into existence. Right. So as for the system to keep functioning, it has to grow. It's the way the system is designed. There is no reverse gear.
Is that because we have an inflationary system? We have an
inherently inflationary system because the debt and the credit has to continually be extended. Right. If it's not continually extended, then it crashes. If you look at the curve of any exponential system, let me take one step back. If you take a number and you increase it every year, even if you only increase it by 1% every year, but if you take something and you always increase it a little bit every year, you will eventually get an exponential curve, which means it goes straight up. Right. And if you ever look at any exponential curve, they never level off. They go straight up and then they crash. And that's the type of system that we have. And so it is inherently inflationary. And if it doesn't continue to inflate, it will crash. And the point I'm trying to make to people is, if they keep extending it, it'll be inflationary. But if they can't keep it, it's going to crash, and that's going to be a deflationary move. And in a deflationary move, the dollar spikes.
Which is already maybe the problem we're seeing on a smaller scale, right? I mean, over the last couple of decades, we continually see the contraction, the deflation.
Yes.
And the Fed rushes back in with the inflation, right?
That's exactly right. And the reason this is, you've just hit on the key topic. There are most people don't know this, but there's actually two dollar markets in the world. There's the US domestic dollar market, and there's the dollar market outside the United States. When dollars exist outside the United States, they're called euro dollars.
Yep.
You don't confuse it with euros. A lot of people confuse it with euros. It has nothing to do with euros. It's just if there's a dollar account or a dollar credit or a dollar, denominator, or if there's a currency outside the United States, then they refer to that as euro dollars. Mm-hmm. And the extension of euro dollar credit, again, outside the United States, has grown to where it's probably the size, potentially even bigger than the dollar market inside the United States. And to your point, when you get these booms and these busts, and the role of a central bank, the point of a central bank is when these busts come, is they come in and they inject new collateral into the system. The problem that we have now is that the euro dollar market rivals the size of the US dollar market, but there is no entity outside the United States that has either the authority or the ability to inject new dollar collateral into the euro dollar market. Only the Fed can create new dollars.
Right.
And so the only way that this is going to not crash is if the US Federal Reserve decides to bail out the rest of the world. Now, I think me and many of the dollar bears agree on that point. We agree right up until that point. And it's at that point where our opinions start to diverge.
Okay.
A lot of the dollar bears, say that the Fed will absolutely bail out the rest of the world. They will provide every dollar that is needed. They will print until the cows come home, and that will decrease the value of the dollar over time. And I don't necessarily disagree with that, but I don't think it will be as easy as many of these people think it will be. I think it will actually be very difficult for them to do. It works completely fine in theory. I think in actual practicality, it's going to be a lot harder. And I think as they get to those points where I think they will be reactionary. So they will print, but they will print in reaction to the downturn. We're talking about that exponential curve. As soon as it starts to come down, right, they'll start to print. But I don't think they're going to print while it's going up. I think they're going to, so you'll go up, you'll come down, they'll print. It'll go back up, it'll come down, they'll print. And I think it's those drawdowns are going to be extremely painful. And I think that is what's going to stair step the dollar higher over the next couple of years, is those drawdowns.
Yeah, great. Well, just for everybody that's tuned in and watching right now, don't leave until the end, because I'm going to ask Brent what all this means, what we should be watching, and maybe what we should be doing. So make sure you stick around for that. But to jump back to what you talked about, you said that only the Fed can create more dollars and inject them. And you talked about those foreign markets, the euro dollar, the shadow banking system, et cetera. But I thought they create their own dollars, and that's why the U.S. has no idea how many dollars exist in that shadow bank.
Okay. Fair point. I should clarify this. So there's three ways that dollars can be created. The Treasury can actually physically print new dollar bills and put those into the system.
Sure.
The Treasury can inject the Fed can inject new capital into the system by doing QE. They exchange new dollars for bonds that they're buying from the banks. And then the third way is that commercial banks can extend dollar credit, right? So they can get extended that way. So when I say that only the Fed can create dollars, what I mean is they're the only ones that can create new collateral from zero.
Right.
So if we're talking about the euro dollar system and we get a contraction, that is the opposite of extending new credit. So they can extend new credit, but if they stop extending new credit and you get this credit contraction, there is no entity other than the Fed that can go out and just inject newly created collateral into the system other than the central bank. And the Fed is like the ECB cannot print dollars. The Bank of Japan cannot print dollars. They can print euros and yen, yuan, but they cannot inject new dollars.
Got it. Okay. So the dollar is the reserve currency, and we've exported those all over the world. but the U.S. has to continue to print in order to keep the game going, keep the charade going. Maybe it's already contracted a couple of times. Now, recently with the pandemic, we saw like a massive demand for dollars and there was a shortage, right, which pushed the dollar way higher. And then I think the Fed response was to print a lot more for the demand, and then it's brought the value back down a little bit. Is that right?
That's exactly right. That's exactly what they did. And the way that they got collateral into the system, both domestically and offshores. Domestically, they did QE, so they bought bonds from banks and gave them new cash. The way they got it offshore was they did swap lines with foreign central banks. So Europe would pledge euros, we would give them dollars in exchange, and then they could lend those out to the banks. And really what it did is it's a psychological thing as much as anything. If the foreign banks know they're going to get new dollars from the ECB or the Bank of Japan as a result of the swap lines, well, then they are more likely to extend credit, and create dollars that way too. Right. So, but basically the Fed's actions, in March and April, did stem that tide. And it's funny, I even put out a tweet literally the day of the dollar high. And I said, okay, anybody new to this game, get ready because the Fed's going to do something and the dollar's going to fall. And if you're a dollar bull, it's going to hurt. This is the way it goes. And that's exactly what they did. Now, I did not think it was going to fall as far as it has, but it has, and it might fall further. I don't know. But what I do know is that fundamentally nothing has changed. The problem has not been fixed. It's just been kicked down the road. Maybe they can kick it down the road for another 6 months. Maybe they can kick it down for, I don't know, maybe another year. But if they continue to, everything they've done has only made the problem bigger. They haven't actually solved the underlying issue. And so that's why I remain of the opinion that while the Fed and the other central banks and monetary authorities can do things to stem the tide in the short term, I still think the potential for a dollar spike much higher than we saw in March is still very much on the table.
Yeah. So I heard you say in another interview that much like the gold bugs want to believe, or maybe the Bitcoin bugs, and I've talked about many times, the death of the dollar isn't imminent and maybe not even likely. Is that kind of what you're saying? Or is that a short term, or is that even like a midterm?
Well, I think the point I want to make is that it's inevitable. Listen, I'm a gold bug. A lot of gold bugs don't like me because I say it might not go to $5,000 tomorrow. But every time I talk about it, I say it's going to $5,000. They don't like it when I say it might go down before it goes up. But I am a gold bug, and I like Bitcoin. I think everybody, if you can afford to own some Bitcoin or Ethereum, or I think you have to have some assets in this, digital space if you can afford to do so.
Yeah.
It is inevitable. This is just math. It's not even hard math. It's very simple math that this system is not going to survive. Now, I don't know if it's going to last 50 days or 5 years, but it's not going to survive in its current form.
Right.
I just happen to think that because of all the way the system is designed, I think it will end by the dollar going higher rather than lower. I completely understand. The end game is the dollar going lower, because after it goes higher and it just crushes the rest of the world, then they're going to have to devalue it or work together to come up with a new system or reset or a debt jubilee or whatever it is.
Right.
So the end game is the dollar losing value, but I think the road to losing value, it's kind of ironic, but I think what leads to it going lower is its spike, if that makes sense.
Yeah, it kills everything else, and then it's the last one left, and then it dies itself, maybe.
Yeah, and part of the reason, and I should say this just real quick, part of the reason the dollar going higher is such a big problem is the rest of the world has borrowed, anywhere from 13 trillion to 25 trillion in dollars. It's hard to measure because it's this shadowy offshore, euro dollar system that you can't even measure.
Right.
But the point is that as much as people hate the dollar and maybe don't like the dollar, they have borrowed in dollars. And until it crashes, that debt is demand for dollars. As long as the system exists, the debt is demand for dollars. Now, if the whole system comes down, then that demand disappears.
Right.
But the reason it disappears, that's the dollar spike, and that's what I'm talking about. Anyway, go ahead.
Right. So the dollar milkshake theory is that the dollar gets stronger in the meantime, sucks all the liquidity from the world, which then brings asset prices up in US dollar terms. I want to jump back into that, like I said, and we'll chase that down to see where you think that's going. But before we do, I just maybe wanted to ask maybe not try to poke a couple more holes, but some recent things that have been happening, particularly during Trump's presidency, really starting to push back on China. We've always known that China held the mass amount of US dollars. They could crash the system anytime they wanted and blah, blah, blah. But things have been amicable, to say the best, right? And now they're not. We've seen just recently in the last couple of weeks, the sanctions with the Hong Kong situation, and now that happening. And after that move, we saw Hong Kong, or I should say China, Russia, Turkey, and Iran start doing their own trades outside. We saw Russia say they're going to start de-dollarization, and potentially, I mean, now, China has surpassed the U.S. in oil imports in most consumer things, and they could easily say, hey, Europe, hey, Australia, hey, Russia, no more U.S. dollar. Do you see that happening? And if so, does that change what could potentially happen with this milkshake?
So I definitely see it happening. And I am not I'm not blind to the fact that de-dollarization is happening. De-dollarization is absolutely happening, but in my opinion, it's too little, too late. So I can't sit here and deny that what you just described is not happening. It is absolutely happening, and China is no doubt furiously negotiating deal after deal after deal to try to get it priced in yuan rather than dollars. Again, and do they have power in these negotiations? Of course they have power in these negotiations, but what they've succeeded in doing so far, in my opinion, is a drop in the bucket to what is needed to avert this crisis that I see coming. Again, I think that they're definitely trying to do it, but having the desire to do something and having the ability to actually execute it are two completely different things. I always use the example that I would very much like to be able to hit the golf ball like Phil Mickelson. But just because I want to do it doesn't mean that I'm able to do it. And the other problem is that, again, the dollar debt issued by entities outside the United States is a huge part of my thesis. So even if the rest of the world were to, or let's say half of the rest of the world were to stop trading in dollars, that means that the dollar circulation would fall by half, let's say, but all the dollar debt still exists. Right. So they would still, that would mean there would be less circulation of dollars. The supply of dollars would fall, but the demand for dollars is still just as high because all that debt still exists. And, if you've got less supply and you've got the same level of demand, that pushes price higher. So again, I'm not going to say these things can't happen. They can happen. I don't think they're happening fast enough to avert the crisis. And even if they do start to pick up, I think the US dollar debt still exists. So I can figure out how we eventually, I can figure out how they push the problem down the road, and I can figure out how eventually the dollar falls. But in the short term, I can't figure out how they get out of this mess without the dollar spiking.
Right. One thing I just want to remind everybody listening is that things would be so much easier for us if we had crystal balls. We don't. And I'm guessing, I'm speaking for Brent, but I'm guessing that he's probably a lot like me and other people where we're not trying to make predictions here. It's about probabilities, right? So we're looking at potential outcomes, and then we watch the way they progress, and then we shift and move as we need. Yeah. I mean, is that about right, Brent? That's
right. My job to a certain extent is a little bit ridiculous. And it's kind of funny to say that because I feel like my job's a very serious job, but it's also completely ridiculous. I mean, essentially what we have to try to do as macro analysts is predict the future.
Right.
And anybody who thinks they can predict the future is crazy, right? I mean, nobody can predict the future. But to your point, what you try to do is figure out the probabilities.
Right.
And I'll give you an example. So my whole milkshake theory is that the US assets will rise versus the rest of the world. Okay. And I think that will happen because the dollar is going higher. And as a result, I've said, own gold, own US equities, for lack of a better word, own some US treasuries, and just avoid the rest of the world for now, right? And then allocate a small portion of your portfolio to some of these asymmetric trades that would pay off in a big way if the dollar spikes. Okay, let's pretend that I'm completely wrong on the way the dollar goes. Let's pretend the dollar keeps going down and down and down. What would that do to US equity prices? Well, that would probably push them higher, right? So even if I'm wrong, I still think I'm in the right asset class, right? And so one of the kind of tricks in our business is try to figure out how much money do you make when you're right and how much do you lose when you're wrong.
Of course.
So in my, my thesis sort of has a safety measure built into it. If I'm completely wrong on this and the dollar just continues to fall, the real estate that my clients own should continue to appreciate in US dollar terms. The equities that they own should continue to appreciate in US dollar terms. And the gold that they own should continue to appreciate in US dollar terms. So in that scenario, the only thing that takes a hit is my reputation. And I can live with that. I don't want to be wrong, but if I'm wrong, I'm wrong.
Well, you got it right. You would get it right. Just the reasoning behind it didn't necessarily work out the right way.
I guess, and that's my point is, again, if you have to have risk controls in this business, and you have to be able to check your ego. And I've told this to people before, of course I have an ego. I'm not going to deny I have an ego. It's hard to do this job without having an ego, but I've had to check my ego on several times in the past. I've had to say I'm wrong several times in the past. And if I get to a point where I feel like I've been proven wrong, I will say that I was wrong. I don't think that we're there yet, but it might happen.
Got it. So that's a perfect segue to jump back into that a little bit. So you talk about the dollar getting stronger, sucking liquidity in. And when you say sucking liquidity in, do you mainly mean like sucking investment dollars in, like people wanting to invest back into the U.S. because it's the strongest current economy?
Yeah. Okay. Essentially. I mean, I think it'll act like a safe haven. It'll. And the thing is, people talk about, let's use gold as an example. Right. As gold goes higher, a lot of people want more of it, right? Because it's a harbinger of danger to come. Yep. So as you've seen gold rising over the last 6 months, more and more people want it. It's like Giffen good, which is that means that a good or a product that increases in value and demand, the higher the price goes. Yep. And so, and as that was why gold, if you were on a gold standard, the gold price would be the interest rate. In other words, as the gold price rose, it would suck capital into it, taking capital away from other endeavors. Right. That would act as an inflationary hedge. As the gold price fell, then dollars would flow out of gold into other more productive means. And so that's why the gold price would be a very good way to manage an economy, right? Now, for many reasons, the government isn't going to do that as much as I would like them to, but they're just not going to. Sure. But I guess think of the dollar as the same way. As the dollar rises, it sucks capital from around the world into it. And as that happens, people from the rest of the world start saying, holy cow, I'm losing more liquidity. The only place that's getting in liquidity is the United States. I want to invest there. So they put more into it, which makes the dollar go even higher and sucks out even. So it becomes this vicious circle, right? Now we will get to a point where the dollar will be too strong. Capital will flow out of it. It'll go back to the rest of the world. The dollar will come down and the rest of the world will start to rise. I just think that we're going to have that big rise in the dollar first.
So when we talk about assets, one thing that I've looked at is obviously the dollar's lost whatever, 90% of its purchasing power. Yep. And so when you look at, real estate and gold, things like that, it's like, well, maybe real estate and gold isn't getting more expensive. It's just taking more dollars to buy those things. And so we know the dollar lost like 10% in the last couple of months. And at the same time, the prices of things went up in dollar terms. So I'm curious how they work together. So I would think the opposite would be true. If the dollar is getting stronger, then the asset prices should come down. But you're saying that maybe the dollar can get stronger and asset prices go up at the same time.
Yeah, I think this is something that many people miss, and not necessarily miss. That's not the right way to say it, but just they haven't seen it before. So maybe it's just not the first thing that comes to their mind is that you can actually have inflation while the dollar is getting stronger. I can prove it to you right now. And again, when I say stronger, when I talk about a stronger dollar, I mean versus other fiat currencies. Okay. I'm not necessarily meaning in purchasing power. Sure. The point I'm going to take just a step back real quick. The point I say when you can make a fortune by betting on the dollar is that if you find trade, there's a number of trades out there that if I'm right and the dollar rises against foreign currencies, in other words, in the fiat world, you can make a fortune. Okay. Now, that doesn't necessarily mean in purchasing power terms. It just means versus, fiat currency pairs. Now, if I'm right and the dollar, well, for the last 10 years ago, in 2008, the dollar was priced, as an example, around 75. Now, since then, the Fed, the national debt has gone from 6 or 7 trillion to 26 trillion. The Fed balance sheet has gone from 500 or 600 billion to 6 or 7 trillion. Okay. And over that time, the dollar DXY index went, and I would argue, most people would say that their cost of living went up over the last 10
Sure,
years,
of
whether it's
course.
healthcare or tuition, whatever,
Yep.
whatever it is. But since 2008, when the dollar was 75, mid 70s, it's now 95, mid 90s, or low 90s. However you measure it, the dollar has risen versus fiat currencies over the last 10 years.
Right.
Despite massive printing, despite massive balance sheet expansion, despite QE, despite cost of living going up, the dollar has risen. So, and look at asset prices. Stock prices have gone up 3 or 4 times over
Sure.
that time period. So that's the point where you can get asset inflation and some consumer price inflation and the dollar going higher together. So this idea that you have to have the dollar going lower in order to get inflation is just demonstrably wrong.
Sure. So then that brings us back to like now working our way down from the top down. Now we get into like individual like asset classes, I would guess. So like, okay, so the dollar is getting stronger. People want to be parked in dollars. People want to be in the United States, I guess the United States markets, maybe even real estate, equities, et cetera. But what about international assets like gold and Bitcoin? Why would they benefit from a stronger dollar? Or would they at all?
Well, no, I think they would, because for 2 reasons. I think we're going to get into a point where the dollar and Bitcoin and gold all rise together, because I think they will be seen as safe haven currencies or assets away from this global storm.
Right.
And you got to remember, if I'm right and the dollar goes higher, it's going to put extreme pressure on the rest of the world. And so from a crisis standpoint, people tend to go to gold in a crisis. So from that perspective, they would go to gold. And if I'm right and the dollar is going higher, then that means the yen's going down, the real's going down, the euro's going down, which means gold's going up even more in those foreign currency terms than it is in dollars. And the same thing with Bitcoin. So I'm a big believer in that everybody should own gold, for sure, physical gold. If you can afford silver and Bitcoin and maybe some of the miners, and you want to take that extra risk, then do that. I just have bullion right now. I'm not in the miners right now, but it doesn't mean that it doesn't have a place in a portfolio. But I think that the dollar strength is going to create this vicious storm where people want even more of the things other than their own currencies. So that means gold, U.S. equities, U.S. assets, fixed income, and maybe Bitcoin or some of these other assets.
Okay. Yeah. So, I mean, it definitely makes sense. And in that scenario, you could see how dollar up, dollar down, Bitcoin and gold are probably going to do really well. Especially, I mean, we saw gold hit new all-time highs in almost every currency out there besides the dollar quite a while ago.
Yeah. And then now, just today, and new all-time high in the dollar today. So we're kind of in this period where the gold is rising in every currency right now.
Right. And because everybody's seeing what's happening. What about real estate? You mentioned real estate. I've talked about real estate quite a number of times. I saw you were on my friend Jason Hartman's show. So shout out to Jason. And we've talked about real estate quite a bit. A lot of people just say, well, oh my gosh, 50 million people out of work. The economy is going to hell in a handbasket. There's no way real estate can continue to prosper. But I think that some sectors could, and I think you maybe agree with that.
Yeah. First thing I'm going to say, you and Jason are better real estate experts than I am. So real estate is not my area of expertise, but first of all, if I'm wrong and the dollar goes down, then real estate's going to be a very good place to be.
Right.
But even if I'm right, I don't know if real estate's going to return the same way it has for the last 10, 20 years. But I don't necessarily think that real estate's going to crash either. So as a portfolio diversifier, as a hard asset, against the currency crisis, I think it can be good. I was up in Tahoe a couple months ago. We went up there, during the quarantine, and I was talking to a local guy, and I was asking him what the real estate market was like, and he's like, it's really starting to pick up, and it's crazy. Just in the last 2 months, they've gone from not too many buyers to multiple buyers on all properties because people are leaving the cities. If one of the reasons you live in a city is so that you can go out and enjoy the city. You can go to restaurants, go to bars, go to the museum, go to a theater or whatever it is. But if you can't do those things, there's no point in paying 3 or 4 times the rent or the mortgage as you could if you live in Tahoe or Bend, Oregon or Boise or wherever it is. Sure. Right. So I could definitely see areas like that continue to do well from real estate.
Now, another question, when you're looking at the big macroeconomic picture, and specifically talking about the U.S. potentially doing really well, I guess is what you think. What about the economy? I mean, the economy right now, we know the economy and the markets seem to be completely disconnected. But at some point, doesn't the economy have to get back on track with this? And just to add, I mean, it looks like the future of the economy isn't super bright, especially depending on what happens with the next presidential election and so forth. So do you look at that, or we don't need to look at that?
Oh, yeah. No, I absolutely do. And so this brings up two good points. And so the first thing I should say is, when I talk about U.S. asset prices going higher and U.S. equities in particular, I fully believe we're going to have all-time highs in U.S. equities. But I think that's over the next 2 to 3 years. I don't necessarily think that's over the next 2 to 3 months or even 6 to 9 months. Okay. I actually think it's more than likely that we're going to have another downturn. I think it'll happen leading up to the election, but maybe it doesn't happen until the first quarter or something. I think we're going to have another downturn in equities. I don't know if we'll go down to the levels we saw in March, but I think we're going to have another hard sell-off. So tactically, even though I own U.S. equities and have clients that own equity, we have some hedges on them because we think we're gonna come back down. But the other thing I want to say is that, in the very first time I ever started talking about this milkshake theory, is that I said U.S. equities are good. Don't buy U.S. equities because things are good. Buy U.S. equities because things are bad. And I said this is not a story that ends well. It's a story that ends horribly. And I don't think that U.S. equities are going to go higher because the U.S. is doing great. I think U.S. equities are going to do higher because the rest of the world is doing horribly. So again, you can get this massive inflationary move in the U.S. And some goods will even go higher. Like prices will rise in inflationary terms. And my point is, I think we're going to get to a point where U.S. equities, big blue chip dividend paying U.S. equities, will be seen as a store of value. And I think valuations will go through the roof. They already are through the roof. Yeah. And, I think, the Microsofts, the Googles, the Apples, the Amazons, I think valuations could double from here over the next 2 or 3 years, which I completely understand sounds ridiculous. Yeah. And I agree it is ridiculous. I just think it's going to happen anyway.
The thing I think of when you talk about, the prices of stocks doubling or gold doubling is, what does that mean for the dollar, right? Like, okay, so gold hits $10,000 an ounce, but like, what does that mean? Bitcoin's $100,000, but what does that mean for the dollar, right?
Well, again, I think it goes up in purchasing power versus other fiat currencies, but it might not go up in purchasing power versus gold or Bitcoin or land or whatever. I mean, those could go up even higher. So again, it's all relative. Right. And again, this is all going to end really, really badly. I'm not this Pollyanna who's saying, put your head in the sand, buy U.S. equities because everything are great. Things are not great. Things are horrible. And they're probably going to get worse. But I just think one of the knock-on effects of things getting worse is U.S. equities going higher.
So really, if I kind of want to summarize it, then I'm guessing that like the rise we see in the dollar strength and the equities and all the other assets, gold, Bitcoin, et cetera, isn't so much dependent on the U.S. doing well. It's dependent on the U.S. doing better than everybody else.
Exactly. That's absolutely right. It's a relative game. Global capital has to go somewhere. I think on a relative basis, they will choose the United States more than the rest of the world.
And we're just continuing to see more and more reasons why nobody should be holding dollars or cash or whatever fiat in their accounts, right? So they're going to have to put it into some type of asset.
Yeah. Yeah. Now, again, I think in the short term, I think deflation is the bigger scare in the short term. So I think we will have another pullback in asset prices, both in the U.S. and globally. But I think after that, then maybe it's just off to the races higher.
Yeah. So that's great. I appreciate that. Now to put you a little bit more in the hot seat. If you've already kind of hinted to, well, I don't want to say hot seat, but I know we're not trying to predict.
Let me readjust.
Yeah. I mean, I know we're not trying to predict things, but just, what you're seeing, what your thesis is or whatever. You've already talked about, a potential downturn, maybe not as bad as March, happening sometime in the next several months to 6 months or something like that, yeah. 6 to 9 months, maybe 3 to 9 months. And then the dollar and assets going higher over the next 2 to 3 years. Give us kind of like the big asset sectors and timeframes that you think as of right now, if you can.
Yeah, so I think very short term, I would want to be in short term fixed income cash. I have equities, but again, they're hedged. So if they go higher, that's fine. If they go down, that's fine. I would, I think gold will probably have a pullback here. It might go higher over the next couple of days, but I think it's going to have a pullback before, it keeps going to all time highs. I think that the emerging markets are in a lot of trouble. The last thing I would want to own right now is emerging markets. The last thing I'd want to own is anything in China. I think Hong Kong and Turkey are on the edge of chaos. So I think, just being very careful over the next 6 to 9 months is probably the best thing to do. Try to avoid, if you don't have the ability to try to make money off the chaos, just try not to get killed in the chaos, survive the chaos. And then after that, then after that, I think I would want to be in, I think that's when the quote unquote milkshake theory really starts to play out, because I think that's when the dollar will rise, U.S. assets will rise, and the rest of the world will. I think Canada is in very big trouble. I think they're going to have a tremendous problem with their real estate. I think Australia, the same thing. I think they are going to have tremendous problem with their real estate markets, and it will affect their currencies and their sovereign bonds. Ultimately, what I think we're going to have is a sovereign bond and sovereign currency crisis over the next 2 to 3 years. Mm-hmm. And as investors around the world decide that they don't want to own sovereign bonds off of which they're never going to get paid back, that money will find its way into U.S. equities.
So then if I'm deciphering that correctly, sometime over the next 6 to 9 months, maybe continuing to bubble a little bit higher, maybe not shooting too higher, probably some sort of a correction, maybe not as bad as March, in the 6 to 9 month range. And after that point, then maybe a pretty consistent climb for the next 24 to 36 months before the whole world basically implodes and crashes.
That's right.
When the whole world implodes and crashes, where do we want to be?
Then you want to go buy EM and international and get out of the U.S. Because when that will be the high, I believe that will be the high of the U.S., the high of the dollar. And so then you go around, you take all your profits that you made in the U.S. and you go deploy them, and you buy, beat up properties in Italy and Argentina and Brazil and Australia and, Hong Kong. And I don't know if you want to be, it depends on what's going on with China at that point. But basically you want to go around and you want to buy up all the things that are in pieces, and you want to sell the thing that's overvalued, which is the U.S.
Yeah. All right. Well, I know we're kind of running out of time. We're going to wrap it up. I would like to just dive into one more little topic. And I know this is a very touchy topic for a lot of people. And really, I think you can't really understand macro without understanding politics to at least some extent, right? And maybe you don't have to make your beliefs known or even agree with one side, but you have to understand the arguments and things that are being proposed, right?
Absolutely.
And so we obviously have an election cycle coming up. I mean, you could argue that no matter who wins, the game goes on, right? But I look at if Biden wins, he's already said he's going to take away a bunch of tax breaks, increase taxes across the board, which I think would obviously hurt the investment landscape. Some people have said that we would see the stock market drop by 10% just off of that alone. And then on top of it, you have his AOC and Sanders group wanting to push a Green New Deal, which if they had their way could get rid of airlines. I mean, that's $1.5 trillion, plus it would add $20 to $90 trillion of spending. I guess that type of stuff, and there's a legitimate chance that stuff actually happens. Yeah. Does that fall into that's 3 years out, 3 years out plus kind of thing?
Yeah. So I will say that, it's funny. I did an interview a couple days or maybe a week before the last election in 2016. And I said, I thought Trump was going to win. And the reason I thought he was going to win then is I have a lot of friends and family in the Midwest. And, just talking to them, I couldn't, nobody was going to vote for Hillary that I talked to back there, despite all the polls. And so I thought that there was this undercurrent of, whatever you want to call it, that was going to groundswell that was going to have Trump win. I thought it was going to be close, but I thought he'd win. And, and that's what happened. And I think that Trump is going to win again this time, but I'm much less certain this time than I was last time.
Sure.
I think, I think he has done some good things with regards to China, but he's handled this whole, not just the COVID, but the protests, I think more than anything, I think he's handled not well, and the timing could not be much worse.
Yeah.
And so I think it's going to be close. I do think he'll win, but I think it's going to be close. Now, I think if Trump wins, that would probably be better for the dollar and the markets in general. And I think if Biden, again, you mentioned the popular opinion is that Biden wins, the market crashes because of his tax policies. And I kind of get that. But, a lot of people said that when Trump was going to win, too. They said if Trump wins, the market's going to crash and And, it didn't. So
Yeah, but he proposed tax breaks and incentives for business, and
right.
he proposed getting rid of 2 regulations for every new one,
Yeah.
which he did 8. Where now we have one saying we're going to give you more burdens and take away, make it so it's a little different.
Absolutely, it absolutely is different. So if Trump wins, I think that would probably be better for the dollar initially. I don't know if it matters too much in the big picture. I think in the first 6 months it might matter. The first 6 to 9 months it might matter. But I think, regardless of who wins, they're going to print a lot of dollars over the next couple of years. But the euro's they're going to print a lot of euros. They're going to print a lot of yen. The point I wanted to make with Trump earlier about I think he's done some good things on China is I think regardless of who wins, one thing that I think Trump has done well is he's brought to the level of consciousness that maybe China, our friendship with China was not to our betterment, right, and perhaps to our detriment. And regardless of who gets in and who is president and who's Secretary of State, I don't think the next administration can go easy on China. So I think that kind of that horse has left the barn. I think whoever's in, we've gone to this G2 world with China on one side and the U.S. on the other, and I don't see that reversing.
Yeah. All right. Well, I think that would be short-term pain, but long-term gain if that happens. But I kind of hope to see that happen. But we'll wrap it up with that. I appreciate you giving us so much time already.
Absolutely.
It's a very, I don't want to say interesting. I mean, it's very believable. It's kind of the way that I see things. I agree with you. I think there's definitely some things to watch that could change things, but seems to be the way.
Well, you always have to be ready to be wrong, right? And we'll just have to see how it plays out.
Now, Brent, where would people want to keep up with you? Where's a good place you want to send people?
Sure. So on my contact information is listed on my website. It's just a landing page with contact info. But if you go to santiagocapital.com, feel free to email me. Feel free to call me. I always tell people, if I don't get back to you right away, it's not because you're bothering me. It's just because I'm swamped. So don't feel like you're about to, email me again. I'll try to get back to you if it takes me a little while. I apologize. I'm also very active on Twitter. You can look me up Santiago Capital on Twitter. I do a lot of stuff there, and then I do a number of these podcasts with people like you. And I'm happy to come back at some point if you want to talk again. And appreciate you having me on today.
Yeah, great. So for everybody, I'll go ahead and link to his stuff, his Twitter and his website in the show notes, so you can look for it there. But we'll go ahead and wrap it up with that again. Brent, thanks so much for joining us.
Awesome. Thank you for having me. I appreciate it.